Nasdaq has been involved in digital assets since 2021 when you launched the Nasdaq Crypto Index. And since then, Nasdaq has been immersing more and more into the space. I want to start off with the very latest because in September, Nasdaq filed an application with the SEC for a proposed rules change to allow for the trading of tokenized stocks and ETPs. So, what was the main driver behind that move? I mean, obviously, we're hearing a lot of interest in tokenized stocks right now. So, I'm sure that was part of it, but what else was in the mix there?
Sure. So the way we look at it is we filed a rule filing with the SEC that really allows our investors and members choice around how to settle and hold those assets and represent them. So either you can represent them in tokenized form now on blockchain, or you can hold them in its traditional form under the traditional accounts. And really what the whole purpose of this is to bridge the digital asset world and the traditional world together, but do it, and some of our responsibility is to really do it with an investor first principles type of mode. So we really looked at this as a way to kind of give investors that level of choice and to drive things forward. I think what's crucial here is that we're not creating a new exotic instrument. The stock is the stock, and that's what's really important, is that we focus to make sure that the investor is first and they have the full rights and title that the shareholder should have as part of owning that share. And what that really means is that when you start to trade that is the same ticker, it's the same CUSIP that's being traded, it's fully fungible between the token and its traditional form. It's just allowing the investor that choice on the back end to be able to hold it as new applications come forward and you have the enhanced utility of that instrument. So really we're thinking about the investor and making sure that they have right and title to the asset, which is contrary to some issuance that have happened. And you want to make sure that there are that same level of investor protections that exist relative to something that may be construed as a slightly of a derivative that doesn't necessarily have the exact right and title to that instrument.
So, expanding on that, as you just mentioned, I know that NASDAQ aims to integrate tokenized assets into current market structures, and NASDAQ argues that current securities laws will apply. So, how will this work exactly? Take us through what will change if the SEC does in fact approve this rules change.
Sure. So the nice thing is when we're talking about from a trade perspective, there's not much that happens day one from just the pure trade aspect of it. And that's deliberate. What we want to do is really bring the ecosystem along. So first and foremost is being able to interact with those shares in the tokenized form. So the trade happens through the order book under the same SEC rules that apply in the national market system. That was important because the rules that have existed for decades, and we don't want to just completely rip out and upend the entire process. So it was very important for us to make sure that we operate within the national market system, but allow to start to see the benefits of having a token and utilize those, whether that be on the post-trade processing, which this is. It allows the post-trade processing to exist in its tokenized form. And also, as new applications come on, to be able to utilize that token in those applications, whether that be in borrowing, lending, collateral, other use cases. We see those as being really the new and forward thinking of what a token can actually be used for. Within the trade and the match itself, it's still the same order book and the same investor protections that you exist and the same best execution that you would receive with the depth of liquidity. I think it's important to really identify that we're looking at keeping the same level of liquidity and that depth of liquidity that exists today. The United States is the envy of the world when it comes to really thinking about what liquidity is. And what we don't want to see happen is the fragmenting of liquidity across various different pools. You would see in stress times that those pools get very thin, and then you have more potential for disruption in the market. So our goal is to really keep that full depth of liquidity and be able to utilize the asset in more forms than it is today.
So what are some of the main benefits associated with allowing for the trading of tokenized assets on the Nasdaq? Obviously, improved efficiency, enhanced audit trails are some key factors, the potential for 24/7 trading. But what are some of the other advantages, if you can take our viewers through that?
Yeah, sure. It's a great question. I'm going to break this down a little bit to near term and longer term.
Sounds good.
So in the near term, you get a lot of process efficiencies on the back end on the post-trade side. So you can now settle in tokenized form. That ultimately, well, today we're looking at making sure that it's seamless with the back end processes that exist at our member firms. But over time, you could see where that can enhance the settlement, even speed up settlement, potentially to atomic instant settlement. However, you also have to think about, you have to bring the industry along with that, because coming with that, there's all of the additional mechanisms, whether that be financing or otherwise, that benefit from the capital efficiency that you get on the delayed settlement. But it is an area that we're looking at. Longer term, and even in the midterm, we think that the collateral mobility for these assets becomes very advantageous for the overall market. So being able to take that equity, put it into a collateral pool, allow folks to be able to move that asset instantaneously, can help along the lines of making sure that you have capital efficiency, no longer needing to have to over collateralize positions. You're able to receive that collateral back and reuse it more efficiently. So I think it's important to realize that the utility comes with things that surround the asset itself beyond the trade, and that's where tokenization really comes through. When we think about 24/7, tokenization doesn't ultimately bring a forth 24/7, or liquidity for that matter. It's all about the market structure that you have around that. We're moving to 24/5. In our traditional markets. And the tokenization, I think, will wind up with our merging along the way in the longer term. But when you think about it, it's really that enhanced utility that you get from the asset beyond just the match itself. And then you can think longer term what the implications are. You can have better access for proxy. You can have enhancements around corporate actions and processing around those corporate actions themselves. So I think it's important to realize that you start to get the programmable nature of what blockchain is and smart contracts are intended for. You start to build into the equities, and it really helps facilitate the asset and the mobility around it.
So if this is in fact approved by the SEC, what would change? Do you anticipate that other major exchanges will follow suit?
So I think we're not looking at kind of upending the system. We want everyone to come along with us for that ride and bring kind of tokenization more into the mainstream. But we want to do it in that responsible investor-led way first, under kind of the SEC rules themselves. So we think that we are kind of looking at pushing this at the forefront of innovation. We've been at it before. We are kind of the original innovator in this ecosystem. When things moved from paper-based to electronic form, we were the ones that kind of brought that into the market. And it's evolutionary. It's not really revolutionary. So we look at it as how can we evolve the system to really bring forth the benefits of it, while really looking at how do we maintain the regulatory, the guidelines and the guardrails that have existed for decades. Not to say that there's always improvement that can be made, but we look at it as make sure you have those guardrails in place and bring the ecosystem along. So we think we're working with many other firms to kind of bring this into the forefront and allow for folks to get the benefits of the tokens.
What's a realistic timeline? Because obviously we just saw the longest government shutdown in history. That's over now, but do you think it's realistic to potentially get an answer from the SEC regarding your filing by the end of the year, or do you think now it will likely get pushed into next year?
So I think what we have to really evaluate where the public comments come back in, and then answer and respond to the SEC questions as they come through. So from a timing perspective, we'll move as fast as we can with the SEC and make sure that we try to push this through. We think that this is going to be an important topic of the administration. So we hope to kind of work with them as quickly as possible.
Focusing on spot crypto ETFs, Nasdaq has been offering these products, including spot Bitcoin ETFs, spot Ether ETFs, but in recent weeks, we saw altcoin ETFs pop up, including Litecoin and Hedera, which are both offered on Nasdaq. So why was it important for Nasdaq to offer these products to investors on your exchange?
Yeah, so I think the way we look at it is we have rules around our listings. And we issued a generic rule filing, so this would allow for ETPs to come through and go through the process of the exchange listing, and as long as they reach those milestones that we set forth in our generic rules, then they should be allowed onto Nasdaq. And we from time to time update those rules, just like we do in all of our products. So we have gone through a rigorous process to file that, which was approved, and we're happy to have these products listed on Nasdaq.
So we mentioned spot crypto ETFs. Nasdaq also launched a crypto custody business in 2022. Can you take our viewers through a brief history of Nasdaq's involvement in digital assets?
Sure. It actually goes even further back than that. So we've been involved in the digital asset and crypto ecosystem for quite some time. So we have a number of different businesses. So starting with our market technology businesses, we offer exchange technology. So we power over 130 plus markets globally. And we have rolled out that technology. So many crypto markets itself use our matching engine technology. So that's been around for quite some time. We also launched the index products. As you know, we list them on our market, but we also have an index team that works on, and we have a Nasdaq crypto index as well as many other reference rates that are used by issuers globally for benchmarking purposes. And then we also we've announced that with our acquisition of Adenza, we acquired a company called Calypso. Calypso is kind of the gold standard when it comes to collateral management and having that and doing the processing and the software around that. And we have now integrated that with some blockchain rails as well. So allowing for collateral mobility, and we think that's kind of one of the killer use cases that exist out there. So we continue to push that forward as well. And then you think about kind of the other areas that we've spent time in. We have data products that we list out and offer to our members and other customers to be able to use those data products within any sort of new product offering that they may have. We have also a robust surveillance business. So our surveillance business is used globally to monitor markets and for manipulation. So that has been also an offering for many crypto firms, and we consider that the best of breed when it comes to surveillance. We do that for traditional markets, and now we've kind of put it in for the crypto markets as well. So we've actually been around for quite some time. We look at ourselves as really the infrastructure of kind of traditional markets, and now moving into digital assets, and that pipes and plumbing and all that infrastructure that exists. We sit behind the scenes, and we want to make this where people can utilize our infrastructure to do their business better, right? So we sit at that pipes and plumbing level for them.
So we have seen this convergence of TradFi and DeFi, Nasdaq, prime example. And, lately we have been seeing all these developments on Capitol Hill, the Genius Act stablecoin bill becoming the first major piece of crypto legislation to become law here in the US. Since then, we've seen a lot of TradFi players move into stablecoins. We're hearing that JP Morgan, the Citigroup, Bank of America, all interested in stablecoins. That's just another example. But how would you assess the convergence of TradFi and DeFi, and what's your outlook for 2026?
Yeah, so I like that you use the word convergence, because sometimes you hear that one's going to take over the other, and I really don't think that's going to be the case. I think when you really break it down in the traditional world, you're really looking at decades and decades of risk management, compliance, and regulatory, right? And that all is part and parcel and needs to converge with DeFi. DeFi has also really shown what programmability can happen at scale when you look at some of the assets and what can really be done with this new technology. So we think that the convergence of those two, bringing all of the regulatory, the guardrails that exist, the risk management that exists in traditional markets, and allowing that with the programmable nature and being able to operate all of this at scale in a regulated environment is really important. And that's kind of why we built the infrastructure we have to help shepherd in this kind of new technology and allow for it under kind of this whole governed and governance program itself. So I think it's really important to kind of understand that these are going to converge over time, and one's not going to kind of rule over the other. And then you asked for about what I think about for kind of upcoming 2026. I think you point out stable coins, right? Stable coins were a huge gainer in 2025, right? And when we start to think about 2026, I always go back to how are we going to bring some of these bigger institutions on, and what are they focused on, and what are the use cases that they look at. So collateral management being a big use case for them. Being able to have capital efficiency is of utmost importance. And when you start to think about what stablecoins can do for that, what tokenized treasuries, money market funds, ultimately equities, if these can be tokenized and be used in collateral and being able to better manage your capital efficiency globally, we think that is kind of where the next phase of adoption starts to occur. And it really starts with all that pipes and plumbing that exist underneath it. And that's what we're there to support.
And it will be very interesting to see if your forecast does in fact come true in 2026. Matt Savarese, Head of Digital Assets with Nasdaq, thank you very much for joining us here in Palm Beach, Florida for Clear Street's Disruptive Tech Conference.
Thanks for having me.
Absolutely.